The Federal Reserve is calling for a potential 20 decrease in housing, and we hate to say it, but the Fed says it may be worse. Now for today's video and the financial bridge, let's simply move beyond the hard spots. But make sure to give this video a like and subscribe before moving on. And if you did, well then, let's continue. Between the first and second quarters of 2022 and 2023, home prices in the United States increased by an astounding 94.5%. That's the peak right there, everyone. And if you sold property April, May, June, you probably hit the peak most places hit. Peak around that time, much of the country is down about 8% on average if you just sort of broadly brush the entire country. So, if you account for inflation, this 94.5% rise from 2013 to 2022, roughly 9 years, here is adjusted for inflation a 60.8% rise. The previous housing boom, which occurred from 1998 and 2007, pales in comparison to the size of this. That means the bubble is bigger than it has been in the past. House prices have grown notably since the epidemic began, from the first quarter of 2020 to the second quarter of 2022. 40% or over half of that initial 94% gain has come in the last 2 years. This is the fastest rate of movement and of indicators of profitability price to rent price to income and it past record highs that we have observed since 1975. The measurements we face today in terms of housing affordability are remarkably worse than those of the Paul Volcker era in the 1970s. Now they give some explanations for this, such as high discretionary income and the ability to work from home, but as for real estate, it becomes frothy because of the popular idea that the current high prices will continue indefinitely. Until the inevitable correction happens, we can detect if we are in a period of exuberance by examining the convergence of 3 different statistics, which are shown in the next graph. Review these real housing prices and the price of renting compared to the salary after inflation. Having just one of them is sufficient. When you go above the 95th percentile, often known as the exuberant level, the graph turns a drab shade of gray. This deeper gray bar graph appears when the number of occurrences of 2 rises above that threshold, and when the 3 of them go up above that level, you get this really dark gray spot or line, and as you can see, we have made it to the extremely dark gray region. Here, the 95th percentile is calculated a little differently than in other contexts. All of the graphing and coloring is based on the 95th percentile, which is the threshold at which people are considered to be overly enthusiastic. The key is to compare these figures to the market conditions during the last housing bubble, right about where we are sitting. I drew a little red line to indicate the distance from peak. The price-to-income ratio is about the only indicator that hasn't skyrocketed here. It has reached its maximum level, but it's not yet popped the previous bubble. The real estate and rental markets are more expensive than they were in 2006, 2007, and 2008, when the latest bubble media was reported. This Fed blog post from the Dalia's Fed argues that the pace of acceleration we have seen cannot be easily reconciled with fundamentals, and hence that the FOMO mentality is indeed taking over. What we have for now is acceleration at a rate that is incompatible with the underlying assumptions. The global epidemic wave became more severe, yet, despite the FOMO-driven bubble, the market is still being supported by a number of factors. The fact that there are currently a large number of homes in various stages of construction isn't doing much to increase supply just yet, as completions are behind schedule. Meanwhile, mortgage debt service payments as a percentage of personal income or personal disposable income are at a record of 3.9%. Comparatively, mortgage payments and other forms of debt were a lot heavier between 2005 and 2007, when the unemployment rate was closer to 6 and 7%. This could change if higher interest rates become more deeply embedded in the economy. But this is unlikely to occur for quite some time, as most people have 15 or 30-year fixed-rate mortgages and are not required to refinance at this time. As for now, there is some time lag between changes in mortgage rates and their impact on household budgets. For that reason, we believe this is the area to look for intense property distress. You need to have some patience. The time to educate yourself on real estate and become as knowledgeable as possible is now. In order to be prepared to take advantage of the best offers when the time comes, it is important to understand the potential risks associated with the housing market and how the US economy may be affected by a decline in the home prices. Rather than a drop in stock prices, Robert Schiller claims a drop in the value of one's home has a greater impact on consumers' propensity to spend their money. And so the Fed somewhat reiterates here that if we face a real that's a flash inflation adjusted price adjustment of 15 to 20%, we could cut 0.5 to 0.7 percentage points from real personal consumption expenditures. If GDP is expected to rise by, say, 2% over the course of the next year, that is a very significant blow, because individual buyers drive more than 70% of the US economy. This is a significant reduction in GDP. Therefore, a significant portion of GDP could be lost if consumers drastically reduce these purchases in anticipation of a possible home market drop. While these factors do increase the likelihood of a crash in 2020, they do not ensure one. However, as the policy rates rise, this possibility grows. We strike a prolonged housing boom, and we could maybe thread the needle, as they say, and weaken the housing market without actually wrecking the housing market. But while that's a possibility, something we really have to accept is that a 15 to 20% reduction is a real outcome. This is the baseline for my assessment. Therefore, I'll give it a 70% probability. According to my most likely scenario, housing market values will have fallen by 15 to 25% from their recent highs. Is it possible that the Fed would claim that their work is getting easier after inflation dropped precipitously in December, January, February, and March? The bond market promptly responds to the new lower interest rates by bringing 10-year yields back down to 2.5%. Suddenly, mortgage rates have dropped back down to 5% from the recent highs of above 7%. Although we believe they are about 6.9 right now, what occurs is that people begin to believe that, okay, the floor is putting a bottom under the market, and perhaps we won't have as much suffering. It seems possible that the housing market could stall at a loss of 10 to 15% if inflation were to fall sharply, a situation rather dissimilar to the one in which we find ourselves at present. That indicates it's a good opportunity to go out and buy some tools to fix up the house. You had best get on a plane and start making purchases. However, it is important to keep an eye on the Federal Reserve because they'll be the market's primary movers. If and when mortgage rates drop back down below 5%, it'll be like accepting a bailout, and we'll realize that prices have already moved downward. There is less of a chance of a fall happening now, but that is not definitely the case. The housing market, in our opinion, will not have a V-shaped recovery like the stock market. Not that you want to lose everything at once, just to have inflation spike again and the property market crash for a much longer period of time. The stock market didn't hit bottom until November of 2011, although the reductions were most severe then. It is ridiculous that that was just 4 or 5 years ago. Times have changed drastically since then. Back then though, there was a property market bubble caused by people who cannot afford homes in the current market. It is different because of the fear of missing out bubbles, which is being fueled mostly by people who are financially stable enough to buy a property. We shall observe the outcome. Now, if you have some interesting thoughts about the things that we just discussed, then feel free to share them in the comment section, and we'd be more than glad to join in. But besides that, we thank you so much for watching. If you like this video, please feel free to give this video a like and subscribe. And while you're at it, might as well click the bell button to stay updated for more of our future uploads. Thanks again for watching. This is The Financial Bridge, and we'll see you soon.